Major funding for these broadcasts has been provided by grants from Madison Realty Capital, New York Community Bank, M&T Bank, AmTrust Title, Ariel Property Advisors, Customers Bank, Capital One Bank, Meridian Capital Group. Additional funding has been provided by grants from AVR Realty Company, Bank of America Merrill Lynch, Briarwood Organization, CBRE, Citizens Bank, Colliers International NYC, Collins Building Services, CPEX Real Estate Services, Douglaston Development Levine Builders, Flushing Bank, Friedman LLP, Handler Real Estate Organization Handro Properties, Hodges Ward Elliott INC, Investors Bank, James D. Kuhn Real Estate Institute at Syracuse University, John Castamatidis Red Apple Group, Kilroy Architectural Windows, Matone Group, Mercantile Bank, Newmark Knight Frank, Optimum Window Manufacturing Corp., People's United Bank, Rockefeller Group, Rosewood Realty Group, SJP Properties, Stonehenge NYC, TD Bank, Terra CRG, the Merengoff Family Foundation, the Moynihan Organization, Moynihan Capital Partners, and these friends. Crystal Apple, money, money, money for investment sales. What's going on with the world of investment sales? What is this about Amazon effect on the city, opportunity zone effect, just the economy in general, and potential rent regulations in apartments? A lot of topics, a lot of discussion, and a lot of people today on the Stoller Report. So I'd like to introduce my guests, James Nelson, Principal for the Tri-State Region Investment Sales, Avison Young. The statistician, Robert Knackel, Chairman of New York Investment Sales, JOL. His former partner and dear friend, Paul Massey, the founder and CEO of B6 Real Estate Advisors. And last but not least, David Scheckman, the Senior Executive Managing Director at Meridian Investment Sales. So, statistician, where are we today?
Michael, you know, that's an interesting question. I think that I'm in the vast minority of folks who feel this way, but I think that the market is actually going to be getting better. The volume of sales after 4 years of being down is ticking up this year. In fact, as we sit here midway through the fourth quarter, the dollar volume of sales is tracking to be up about 30% from last year. The number of properties sold is tracking to be up about 3%. And we see fundamentals starting to firm up, so we could have a little bit of price appreciation next year. So I think next year is going to be good. Most people don't think so.
You know, in the green room, we were talking about potential rent regulation on multifamily. James, what were you saying about that?
Sure. I think it really depends on what and where, and multifamily has certainly been a challenge this year. With the recent elections and the shift up in Albany, unfortunately, I think there's going to be some challenging times ahead for multifamily owners, especially with rent regulation, looking at maybe the elimination of luxury decontrol, preferential rents. But where there's a shakeup like that, it can create opportunities. And as we were saying before, if you're a mom and pop owner with 1 or 2 properties, it's going to be pretty challenging to continue to operate and hold on.
I'm going to ask the person who is planning to run for mayor, how do you see the rent-regulated sales of investment properties?
I usually would let Bob answer all my questions for me. But I think, you know, talking about the city and the mayor, we have a housing crisis. So I think that even with the issues of regulation, we have a deep need for affordable housing in the city, and we need to be building it at a level that no one's imagining right now. So I think that's going to maintain a stability in the housing market as much as regulation might be a difficult climate for people. There's a fundamental underlying need.
I seem to agree with you. What do you feel?
I think there's four drivers that are really going to affect continued downward pressure on multifamily. And I think the witch hunt environment that we're in politically on a local scale, both from the Public Advocate's Office and talking about a predatory buyer list. I think a lot of the noise and the recently rejected first iteration of commercial rent regulation, there was a misnomer, I'm not sure what it was officially called, but that's what it is. Water sewer taxes continue to rise at an alarming rate for a city like us. We're one of the highest in the country. And the fourth is just sentiment is shifting because pricing had gotten too darn high and interest rates have risen. So I think multifamily is going to quickly become one of the most challenged asset classes.
Bob?
Yeah, Michael, I agree with that. You know, there are always unintended consequences when new legislation is proposed, new policy is adopted. And for decades, the Assembly has been proposing a slate of changes to rent regulation that have seemed really way out there, but because of either a Republican-controlled Senate or through the IDC, a Republican-controlled Senate, there was little chance for major structural changes to rent regulation. Now, based upon the election results in November, there's a very real possibility that rent regulation is going to be fundamentally changed. The unintended consequence of those changes is that there will be a significant deterioration to the quality of the housing stock. I remember my beloved Yankees were in the World Series against the Dodgers, and the blimp pans to all the fires going on in the Bronx, and Howard Cosell says the Bronx is burning. Well, the Bronx was burning because it was more financially feasible for owners to burn their buildings down than to invest in them. And the MCI came along, and the IAI came along, and tremendous incentives for the private sector to invest tremendous amounts of capital into the housing stock. That could go away if the changes that have been talked about do indeed get implemented.
Everybody wants to own a piece of the apple. They want to be here. The market is still here. It's always going to be the world's leading place to own some property. You're going to have difficulties, and you always have difficulties with government and regulations. Let's focus on this discussion of the opportunity zones. Not everything's out there, but people are saying they want to go in it. They don't understand. There are crowdfunding companies who are going into the idea. What's your thoughts about opportunity zones?
I think it's a new source of money. I think it's fantastic. I think I worry about in some ways that it's, I don't want to say too good to be true, but the benefit once you've invested of having no capital gain, it is an unbelievable opportunity for people.
I agree. I think the big question is to make sure the investor realizes that it's a long-term hold.
I think that's pretty clear, Michael. We've had our accountants in coaching us on what they think it's all about, and I think people understand the fundamentals of it, that it's going to be a long-term hold. But I think on a bigger scale, it's going to cause a lot of investment in pockets of this city that in some cases need it very badly. In some cases, like a Greenpoint, for example, is already on its way. But a lot of capital coming into the market that's going to
look, it's
fresh capital.
Red Hook and other parts, portions of the Bronx, portions of Harlem, and so on. How do you see it in your business?
You know, a rising tide brings up all the boats, and I think that the most exciting thing for us as brokers is it's previously unknown capital. It's not just going to be folks who aren't in real estate as a primary line, and everybody's talking about opportunity funds. Bob mentioned before we got on, you don't need to necessarily be in a fund structure to invest, nor do you need to necessarily be an accredited investor. So I think you're going to have tons of people flocking to it, and I think some of the advice that's going to be given in the beginning is misguided because it's nascent legislation, but at the end of the day, the structure that they set up, it's a new type of 1031. And we all know what 1031s did, notwithstanding the legislative intent to help farms.
Look,
it helped the coastal cities.
Okay, let's look at what 1031 had on the New York market. I mean, just in general, at least 30% of the investment sales was due to the 1031 pass-through.
Right.
I'd say
And I don't think that goes away, because real estate operators, investors who want to just continue to upgrade their investment and defer and not have to pay to the capital gains, the 1031 still works great. But I think the key with the opportunity zone, again, is this new source of capital coming in. I've heard that there's as much as $6 trillion of embedded capital gains in the market. Hopefully everyone doesn't go to the stock market and pull it all at once.
The irony is that many of the large brokerage firms, they're going into these businesses because they want to continue to have the capital that they had from the investor before in the market in the opportunity zone. So they'll earn fees on that. There'll be additional fee income.
Yeah, Michael, there's no doubt the whole opportunity zone mechanism has the potential to be the largest community development program or initiative this country has ever seen. But it's important for folks to remember that you only get a benefit from the opportunity zone if you make money on your investment. So you can't overpay wildly for a property, because if you don't make any money, there's no benefit to investing in the opportunity zone.
As Don Peoples said to me on a show that we did on the opportunity zones, he believes that this is like the National Historic Tax Credits. It's going to help improve certain opportunities for a different area. Historic credits came in at a certain time. This is the new item for today.
But Michael, I'm sorry to interrupt you. What's most important about it is the receiving site, ultimately, you could go into it and spend money. Let's say it's a garage that I was just looking at on the outskirts of Bay Ridge. You can buy it, but unless you're able to add value, change use, put in more capital, and wait for that appreciation to come over time, it's otherwise a fallacy.
You didn't tell him, Mr. Knackle, he can open up a bar over there?
We've talked about that.
That's legitimate. That's a use of a business it's creating.
It is, but the capital needs to be spent on the edifice, on the property, and we're still waiting to see exactly how it has to be deployed.
Okay, let's get to the next big topic of the world, Amazon. Newark offered $7 billion incentives. They didn't get it because they didn't have all the benefits needed by Amazon. How do we see Amazon with regard to Queens investments, the city investments, and in general? Thoughts?
Queens Day has come. It's a fantastic thing. It's fantastic for Queens, but it's great for the whole city, because it signals that we're a tech-friendly city, that we've got an employment base that Amazon wanted and it's going to benefit from. So I think it's fantastic.
No question. I mean, the prospect of 25,000 jobs and beyond, and it really does signal that we have the workforce here and the talent. And meanwhile, Google has just been cranking along with certainly well-deserved fanfare, but people forget they already have 8,000 employees here. After buying 111 8th Avenue, they've now bought Chelsea Market for $2.4 billion. They're headed over to Pier 57. There's talks now that they're going to be occupying St. John's. Google is well on its way to having 25,000 jobs here as well. And for every square foot that a Google or an Amazon takes, how many other companies benefit from that? So, I mean, this is incredible news for the city. However, I do not want us all to forget what happened to Alliance Bernstein moving to Nashville. I mean, and David, you spoke a little bit earlier about the cost of doing business, the taxes, all these things that are passed through. Maybe not for Amazon, which got a ton of incentives.
You see, but a lot of the incentives of Amazon is something that any company, if they would have relocated to Queens or any of the five, including north of 96th Street, under the REAP benefits. So this is a company who's just taking advantage of certain things that could have been available to any company over there. I think the biggest problem that the Amazon effect is something that we talked about before, housing. We don't have adequate housing in the city of New York. And the good effect of Amazon is it may help investors, but the bad effect is that the land prices are going to go up.
Well, if there was any knock on Long Island City, is that there was an oversupply of residential units coming on the market, and that fear is now off the board, because apparently the absorption of units has gone up by a multiple, and
nobody moved in
a lot of
yet.
interest there.
That's right, but the calls are coming in. I do think they're going to displace people, because even though they're going to be vertical and you're going to have low-paying jobs all the way up to the super high-paying jobs, people will be displaced from the immediate environment, but what's going to happen is you're going to see a very positive ripple effect. People may have to live in far-flung places like Bay Ridge, Coney Island, Gravesend, places that are still affordable, that haven't been progressing as quickly as the Red Hooks and some of these other neighborhoods. I think it's only going to serve to improve Corona, Elmhurst, Flushing. That's where people who are living there now may have to move a little
What
further
about,
out.
you know, an area that nobody's talking about, and, you know, Paul said it when the Queens has come with this type of situation, is near Aqueduct Racetrack. Okay? Nothing, with the exception of the Genting Resorts Casino, which is probably one of the most successful in the world today, nothing has happened in the neighborhood.
Well, I don't think that's exactly right, and there's the wrong place to correct you, but not too far from Aqueduct is Belmont, and we've got, what, more than $1 billion going in there.
It's not Queens, it's Long Island.
I think it's right on the cusp, and the effect is going to be for Queens, but your point's well taken. I think Aqueduct is probably one of the last large parcels in this city. It's long overdue for the surrounding environs to be raised.
So with all these people over here, what's the effect on hospitality sales, hotel business? Your thoughts about that?
Well, again, I think it really depends where, and it is such a specific market, you know, certain neighborhoods, and there was concern that, I mean, the last stat I heard was that there was 110,000 hotel rooms in the city, and that's expected to go up to 120,000. But meantime, the ADRs are going up. But it's really specific on the neighborhood, and certainly with the news of Amazon, that helps the Queens market. But the prospects for hotels, especially downtown right now in the financial district, and you look at the tourism that's going to the 9/11 Memorial, and once the World Trade Center is fully built out, the Beekman Hotel is doing incredibly well, Mr. C's. So it really depends what and where.
Michael, it's remarkable how well the hotel industry is doing and what tourism is like, given that the dollar has strengthened so much. You know, the weak dollar, actually, people talk about the weak dollar as being a motivator for foreign capital to come buy income-producing properties here. I never believed that was the case. But what the weak dollar does do is it makes it so expensive for Americans to travel overseas, they end up coming to New York. And actually, over 80% of the tourists that come to New York every year are Americans.
No question. Paul, what's your thoughts about, you know, retail sales, investment sales of retail properties? Because the rents are down, still have a large vacancy factors, different, you know, the e-commerce effect in general.
I think if you look nationally, this whole retail apocalypse is not happening. I think your fundamental strip mall, suburban mall with supermarket anchored, they're full, their inline stores are services businesses. So I think we have gone through a lot of change in New York on the retail landscape, but I don't believe in this word that everyone's linking to it, this apocalypse. I think we'll stabilize, and I think fundamental services businesses will fill up our stores again. And I think we've seen the worst of that kind of dislocation.
How do you see the effect of co-living? I did a show recently on co-living, where I had co-living operators and I had an owner who was very happy. How do you see that effect having an effect on your investment sales business?
I could give some thoughts on that, but I just want to go back to the retail comment before, because I think it's important, and Paul is right. I think it's just a question of the rents getting out of control. I mean, yes, e-commerce, whether it's 10%, 25% of all sales, what happened where in these major retail corridors, these rents doubled, tripled, quadrupled in a 5-year period. So we're just seeing a market reset, and the stores will rent at the right number. And David had referenced earlier this commercial rent control, which is really a response to seeing all these vacancies. The free market will solve this problem, so I just want to make that point, which I think is important. As far as co-living, I think today it's all about flexibility. When kids graduate from college, they want a place. They don't want to have to think about furnishing a place, making a long-term commitment.
When Massey Knackle was started, we've been in the co-living business for the past 70 years, okay? There were owners around who've had apartments. Okay, they would have rented to 3 people. It's been co-living. But today, when an investor looks at it, I had a very bright guy who said, I have 16 apartments in the building. I lease it to Common. They manage it for me. I'm getting a higher rent than I could ever get. I'm very happy with it.
If you look at co-living in Europe, they have evolved so far ahead of us in terms of what's going on with co-living options that I think that wave's going to come here. I think it's going to exacerbate the housing shortage that we have, but I think it's fundamentally going to be a boon to investors here. Then I think the co-living giants are focusing on New York in a big way right now.
And you know, the city right now has administration effect that they're trying to make the smaller apartments available because there's not enough housing, as we brought up. When you're selling properties to the office buildings that have significant amount of co-working tenants, how do you see that on an investor side?
Well, I'm seeing the investor interest is tremendous, but it's all tethered. Their interest is tempered oftentimes by the proceeds that they'll get from the bank. So banks aren't as keen, as a general rule of thumb, and there's tremendous exceptions, to lending to co-working.
To address your point on the co-working side, there have been studies done that show that if you have up to 30% of the space in the building leased to a co-working tenant, it actually enhances the value. But once the percentage leased goes above 30, it actually puts a little upward pressure on the cap rate. So it's a positive thing for the building, but it could to a point, and then after which, you have to look a little more closely at the composition of tenancy in the property.
I think WeWorks is going to have a lot of competitors in the next few years, and I'm very interested to see where that goes.
Right. I did a show on the topic, and I had a couple of co-working companies who believe that they want to go into the management business, and that's where the opportunity is, in the same way as managing hotels. Get a management fee, an incentive management fee for profitability. I also had some owners on the show who said we'd like to have the flexibility because we don't always need a conference room, so it would be nice to have the convenient idea of having conference rooms and so on.
I think CBRE entering the co-working space is very telling.
Besides CBRE, when a company like Tishman Spires creates something called Studio, where they're going to be in a variety of centers that people from their offices around the world can go into, are interesting. How do we see industrial today? Regular industrial and the industrial being converted to office, which was the big market. Do you still see that as a big area of opportunities?
It remains white hot. But I think that what's happening now is people talked about last mile distribution and places like Maspeth in the Bronx and all of the waterfront to get into the city. I think what we're starting to see industrial is last quarter mile or last tenth of mile. And you're starting to see people take some of the roll-up garages on the outskirts of the city that may be as little as 10 or 15,000 square feet, and you're going to have subcontractors for carriers and for warehouse distributors. You're going to have them subcontracted. So I think it's going to continue because it's continuing to evolve along with the internet, but the prices have gotten to the point where it's pretty thin unless you believe there's going to be continued appreciation in the rents.
What about the industrial properties which are being converted to office?
I think distribution is going to drive so much of this that I don't see that trend becoming a big issue.
If you look at the Brooklyn office market, which was 25 million square feet of office, call it 5 years ago, now it's 50, 60 million, and finding large tenants who want to take space, I think has been a little bit of a challenge.
Yeah, Michael, you look at the industrial space and how it's so in vogue today. A lot of the growth in industrial has been caused by industrial changing from just industrial to a hybrid of industrial and retail. Retail didn't really go down that much. Retailers just figured out that they don't need to warehouse and sell out of the same square foot, that they should be warehousing somewhere else and selling out of a different amount of feet. So I think that retail hasn't been as negatively impacted as people think, and actually retailers looking at space differently is what has created the robust acceleration that we've seen in the industrial market.
What about neighborhoods like East New York, Coney Island, Corona? Do you see that as the next horizon and something that nobody talks about? after all these shows, Staten Island?
They already are, Michael. The money's already going there. Warehouses on Wharton Avenue in East New York, which were going for $80, $90 a foot just 6 and 7 years ago, you have asking prices of $250 an existing foot. It's logical because you have space. We're going to run out of, in the next 5 to 10 years, large tracts of land. So I think people are already investing in Staten Island, which is still challenged because you have to take the bridge. The waterway isn't ripe for carriage. But going back to a point that Bob said, I think you said that retail rents, in effect, have not only stayed where they were at the zenith, sometimes they even appreciate, except those retail rents aren't being paid in stores, they're being paid in warehouses. Industrial is the new retail, and we'll continue to see it appreciate.
Before we get to the end of the show, can we just say how much, how glad we all are to be here and how great it is that you do this? I think the industry, everyone in the industry loves these shows and loves that you do them, and I think all 4 of us really owe you a thank you. It's fun to hang around with our old cohort too, but this is really, it's really fun to be here and fun to do this, and we owe you for that.
Tremendously.
Thank you very much. So with those comments, I will have you back in a couple of months. Okay? And because it's always enjoyable to be with the buddies, I'd like to thank James, the statistician, Robert. You kept good today on the statistician. Your buddy in crime, how many years ago did you go into business together?
Yeah.
35?
Yeah.
35?
35, yeah.
Paul, and needless to say, you couldn't have a good time without David. And I'll see you next week.